In a move that has sent ripples across the tech and investment world, SoftBank Group has sold its entire stake in Nvidia, netting a staggering $5.83 billion. The decision underscores the Japanese conglomerate's renewed focus on artificial intelligence ventures at a time when global investors are carefully scrutinizing the massive sums of money flowing into AI. SoftBank founder Masayoshi Son has long been known for bold, high-stakes bets from mobile telecommunications to vision fund investments. And now, Nvidia, a company at the heart of the AI revolution, has become collateral in his latest strategy. The sale raises questions not only about SoftBank's capital allocation, but also about the broader trajectory of AI funding and how corporate giants balance risk and reward. SoftBank's decision to liquidate its Nvidia holdings is far from a reflection of skepticism toward the semiconductor giant. Nvidia remains a powerhouse in graphics processing units and AI computing hardware, a company whose chips have become synonymous with AI training and development. Rather, the move signals Son's urgent need to free capital for multiple AI initiatives, including the expansion of data centers under the Stargate program and ambitious plans for AI-driven robotics in the United States. Analysts note that while Nvidia's growth story is intact, SoftBank's cash-out aligns with a more immediate objective: funding projects that could position the conglomerate at the forefront of AI commercialization. Investor reactions to the sale have been mixed. Some market participants interpret the transaction as a prudent cash management step, ensuring SoftBank has liquidity to back high-cost experimental projects. Others question whether the timing reflects concerns about inflated AI valuations. AI, while hyped as a transformative technology, carries inherent uncertainties, from regulatory hurdles to market adoption rates. By selling a high-profile asset like Nvidia, SoftBank is effectively converting a proven, high-performing investment into the fuel for risk-laden ventures that may take years to generate returns. This balancing act between secure holdings and speculative growth is at the heart of Masayoshi Son's investment philosophy. The scale of SoftBank's AI ambitions cannot be understated. Stargate data centers aim to create cutting-edge infrastructure for AI computation, while robotics initiatives seek to integrate advanced AI into physical automation, potentially disrupting industries ranging from manufacturing to logistics. These projects require not only significant capital, but also careful strategic execution. By liquidating Nvidia, SoftBank is signaling a prioritization of internal growth over passive investment gains. Yet the move inevitably places pressure on investors and market observers to assess whether Son's vision will translate into tangible returns, or if it represents a high-risk gamble in an already crowded AI investment landscape. SoftBank's bold pivot to AI comes at a moment when global capital markets are intensely focused on the sector. Investors are closely watching AI startups, chip makers, and cloud infrastructure companies, all vying for dominance in a technology expected to redefine productivity, entertainment, and even human-computer interaction. By liquidating Nvidia, a company with a rock-solid market position and consistent revenue growth, SoftBank is demonstrating a preference for long-term strategic bets over short-term financial gains. Analysts suggest that the move could serve as both a message to the market and a signal of confidence in the company's internal AI roadmap. Despite the inherent risks and uncertainties that surround unproven ventures, Masayoshi Son's strategy is shaped by his history of audacious investments. From early stakes in Alibaba to vision fund bets on emerging tech, Son has repeatedly proven his appetite for high-risk, high-reward opportunities. In this context, selling the Nvidia stake is consistent with a pattern of reallocating capital toward transformative projects rather than holding on to mature, market-leading assets. Critics, however, warn that even the most visionary plans must contend with operational challenges, regulatory scrutiny, and competition from both domestic and international AI players. The question now is whether the billions freed by the sale will be deployed efficiently, or if the gamble could stretch SoftBank's resources too thin. Industry experts point out that Nvidia's stock has been one of the defining success stories in AI hardware, powering everything from machine learning research to generative AI applications. SoftBank's exit could potentially be interpreted as a missed opportunity by some, especially given the explosive growth in AI adoption across enterprises and consumer technology. Yet the strategic rationale is clear. Converting a high-value, liquid asset into operational cash gives SoftBank the flexibility to shape its AI ventures in real time, funding acquisitions, research, and infrastructure that might otherwise be unattainable. In essence, the sale is less about exiting a booming market and more about doubling down on self-directed innovation. Looking ahead, the market will be watching closely to see the impact of SoftBank's capital deployment. Will the money from Nvidia seed the next generation of AI breakthroughs, or will ambitious plans encounter the obstacles that have derailed other large-scale technology projects? For Masayoshi Son and SoftBank, the stakes are enormous, but the potential payoff is equally significant. By betting aggressively on AI, the conglomerate is embracing a future where innovation, speed, and scale could define the next era of technology leadership. As investors, competitors, and analysts analyze the unfolding strategy, one thing is certain: SoftBank's Nvidia sale marks a defining moment in the ongoing AI investment race, with global implications for the technology industry. Beyond the immediate financial mechanics, SoftBank's Nvidia sale sends a broader signal about how legacy investment conglomerates are approaching AI. The decision underscores a growing trend. Established tech investors are willing to exit even high-performing positions to fund new, high-risk ventures that could define industries over the next decade. For SoftBank, the sale isn't simply a liquidity play. It's a statement of intent, demonstrating a commitment to shaping the AI landscape on its own terms. Market watchers will be tracking every subsequent investment, acquisition, and infrastructure development to assess whether Son's vision will translate into tangible technological leadership or remain an ambitious blueprint in a crowded and volatile AI ecosystem.